Okay, guys, welcome back. And today we have to discuss another topic in the SBR, and this is our lecture number 4, SBR, and we have started the ethics chapter. And today we'll discuss about the very interesting topic that is related both to the very important both from the uh, theoretical perspective as well as from realistic life. So first we have to understand that what we mean by fraud, that what is fraud, and then after that we discuss that actually fraud is actually a broad term, and you may say like this is an umbrella term, and there is types of fraud different in different shape. You'll see fraud, some are financial fraud, some are ethical fraud. So we have to discuss one by one. First we have to understand that what we mean by fraud is actually when someone intentionally when someone intentionally deceives another person or group, then we call that is a fraud. So it is done. There's some motive behind this. That why the people are doing fraud, and the reason behind the motive behind the fraud is that it is done to gain something valuable. When you want to something valuable, something valuable. So when you are looking for a thing like this, and you intentionally, deliberately do some, you want to deliberately deceive someone for gaining something valuable like money or power, then we call that as fraud. Now, it often involves there is some angles of fraud that it often involves lying. Someone lied. There is hiding of the truth. These are the angles, or you may like say tricking someone. If you want to trick with someone, then it means that you are doing fraud. When doing this because of your intention and to get this thing like getting something valuable, then it means you are doing fraud, right? Now, if we see here, fraud is a deliberate act to gain an unfair advantage. It is both at unethical, so this is unethical, and it's also criminal. Now we have discussed what is financial fraud. Financial fraud Financial fraud is actually, as it's a type of fraud focused on money or asset. Then we call that as financial fraud. So when the fraud is actually focusing on money or asset, then we call that as a financial fraud, right? Now here you see financial statement problem. Financial statement fraud is actually you are overstating or understating liability or asset or revenue, then you are just manipulating the financial statement, and that sort of fraud we call that is financial fraud, because you are hiding, you are lying, or you're tricking your investor by doing this, that you are understating your liability, overstating your asset, understating your expenses, overstated your revenue. When you're doing like this because you want to impress your investor, and that is the reason you're going for that sort of act. So you are committing a crime and unethical activity, right? Let's move on. We have some common methods of financial fraud. Okay, so we have already understand that what is fraud and why the people commit fraud. So reason for doing fraud is we have discussed that people commit fraud to make a quick money or avoid losses. They might want to look successful to other like investor or bosses. So some do it out of greed or pressure to meet goals. Other hide mistake or bad decision to save their reputation. So these are the reason behind the fraud. Now we have some common example that we have already discussed, that sometime when you are overstating or understating the asset, revenue, or liability, then this is a type of financial statement fraud, right? Now let's start from the revenue. Revenue overstatement, you see. So this is when a company inflates its sales figure to look more profitable than it really is. Think of it as putting a shiny filter on a dull financial statement, right? So the definition of this overstatement, revenue overstatement, is that a revenue overstatement involves recording sales that haven't happened yet. So you are recording the sales that haven't happened, and double counting sales, you may doing like this, double counting sales, or even making a fictitious customer. So when you are doing this, then it means that you are doing revenue overstatement, which is a financial statement fraud. Now what is the motive behind this revenue overstatement financial fraud? The motive is simple: to impress your investors, You may need a loan, so you want to secure a loan. You may also want to boost stock prices, right? And it's all about painting a rosy picture, right? Now, what will be the consequences if you are doing this? The consequences will be when the truth comes out, the stock prices definitely, if you have just overstated revenue to boost your stock prices. So the stock prices crash, there may be lawsuit file off and regulators come knocking. So trust evaporated faster than you can say, audit. Now let's talk about the ethics perspective because we are discussing the SBR from we have a big portion related to the ethics. So as for the ethical perspective, we concern that from an ethical standpoint, this violate integrity. If you are doing this, then it means you are violating integrity, and plus you can also say that you are violating transparency because you are putting wrong image in front of your investor or stakeholder or shareholder. Okay, so these are the core principle: integrity and transparency of accounting and also ethics. So stakeholder deserve truth and not a fairy tale. So you have to present a true picture of your financial statement of an element that is revenue, right? Now so look at here how it happened. Fake sale recorded, revenue recognized before being on, caught up error. An example is regarding future sales and the current account. So you have not, the sale has not yet happened and you have recorded. So that means that you are overstating your revenue. Now let's move on. We have another element that is the expense understatement. Now you have expenses in your profit and loss account and you are understating those expenses, then it means that you are doing the financial statement fraud, right? So this is the opposite trick, hiding costs to make profit look bigger. Before you are doing the old statement of revenue to look your profit empty, but now you are doing the other way. You are doing fraud in other way. You are just reducing your cost to look, because if you see here you have revenue, then your cost offset and then profit. So if you reduce this amount and this amount remains same, then definitely your profit goes up, right? So it is when a company delay recording expenses, misclassify them as asset, or just forget to mention them altogether. So this means that you are doing the understatement of your expenses. Now, what is the reason? And the reason is we sample that. What is the motto? That to show higher profit and keep shareholder happy, or dodge tough question from the board. And the consequences will be definitely the short-term gain, turn into long-term pain. You understand what I'm saying? And fines, there is restatements or tarnish reputation. So things like that will happen if you are playing this game. So delaying expenses regarding wrongly capitalizing expenses. There's some standard that dealing with the when you have to capitalize your asset, when you have to capitalize expense is an asset, and when you have just to write off. Now classifying repair costs, you see here new asset purchase. So this is the repair cost and that should be expense, and you capitalize it as an asset, then you are doing wrong thing, right? Now, what will be the ethical perspective for this? So this is actually, the betrayal of fairness, and understanding expenses mislead everyone relying on those numbers. So think like an investor or implies counting on a stable company. So you have to show your expenses in a transparent way, right? Now let's move on. We have another concept that is the overstatement, asset overstatement. Now asset overstatement is when a company pumps up the value of what it owns. So this means that you are overstating your asset. Let's say your asset value is $500 and you are showing that this is the $700 things, and you are just pumping up the value of what it what you actually own. So it means that you are not aligned with the fair value. You are not aligned with the market value. So a statement is inflating your inventory values, or valuing properties, or refusing to write off the obsolete equipment. So when you have there's some asset which impair happen, and you don't want to write off those obsolete equipment, so that means that you are overstating your asset. And the motto behind this is to look stronger on a balance sheet, maybe to secure loans or avoid takeover. So this sort of thing, when you have this type of motto, then definitely you will go for the asset overstatement. And the consequences will be that when the real value is revealed, the credit panic, stock prices plummet, and legal battle begins. So definitely you have to pay the consequences if you are doing this sort of fraud. So failing to write off bad debt, you have bad debt, mean you have receivable and you are not unable to recover the money from that. So that would be bad debt, but you are showing that as an asset. So that means that you are overstating your asset. Obsolete inventory, you have some inventory and your stock and that is now useless, they are worthless, and you are still showing that inventory as an asset, and you are valuing that asset. And fair asset, if you have some asset and that is damaged, let's say the work was 500 and now it's damaged, the work goes down to 300. So you have to write the asset with 300, not 500. If you're doing like this, then it means you are overstating your asset. keeping worthless stock in the financial record. So this means that you are overstating the asset. Fine. Now let's talk about the liability understatement. So when you have liability and your balance sheet, then it means that you are you have some debt, and definitely you have to pay those debts. So when this will affect your gearing ratio, and when you are when investor see this sort of thing, that you have, your liability is very high, so definitely they will not invest in your company. So this by liability understatement, we means that hiding loans. Definitely, if you hide loans, that it means that you are understating your liability. Under reporting legal obligation, if you have legal obligation and you are just you are covering those illegal obligations and you are not reporting, that it means you are understating your liability. You may say like that, ignoring guarantees that will cost money later. And the reason behind this is to look less risky to investor or lender. Less debt is equal to more trust, and we know that if you are not in risky position, then definitely your trust will be prevail in the market, and the investor will invest in your company. Now, the consequences of understating the liability is that when the hidden liability surface, the chaos, bankruptcy, lawsuit, and your reputation will be shattered. Right now, from the ethical perspective, if you look from the ethical perspective, then this is a breaches accountabilities, and stakeholders have right to know the full risk they are signing up for. So these are the things that we have discussed, that how the liability understatement is fraud, and this is why we call it as financial fraud. Now let's move on. We have another concept, that is misapplication of accounting rules. So when it is using a loopholes, or twisting standard like IFRS or GAAP to justify a dirty number. So when you are playing with the numbers in a way that is just twisting it, then actually you are this is the misapplication of the accounting rule. And the reason behind this is just you want to dodge red flag or meet on your target without breaking the speed. So consequences will be audit cage on eventually, and leading to restatements, penalties, or lost credibility. Okay, this is the consequences. But if you look from the ethical perspective, that which is our main concern is here, this undermines the profession integrity, and which is the core principle of ethics. So accounting rules exist for consistency, not creating a storytelling. And we have already discussed this in the IS1 presentation of financial statement, that why the financial statement, why we have to follow the proper format, because for the consistency, because for the comparability. And it's not about that you are just use the thing from your own interest and for your own benefit. Right now, let's move on. We have the omission or misrepresentation. This is another financial statement fraud. What we mean by omission or misrepresentation, it means that we leaving out key details like looming lawsuit or twisting fact to mislead readers of the financial statement. So that we call that as misrepresentation. Mean the thing which actually need to be presented, and you are just skipping those things, and you presenting that in a way that is just twisting and confusing your reader, confusing your stakeholder, confusing your user. So that means that you are misrepresenting, and that is a financial statement fraud. And you appeal sometimes you are omitting something, and that is very important for the user, and you are omitting the thing for hiding something. Then it means that you are doing the financial statement fraud. And what is the reason behind this? To avoid panic or to keep stock price afloat. Silence can be golden. We think like that until it is not. So we think that if we are silent, by omission we mean that if you are silent, that everything will be this is just a proof that silence can be gold until it is not. Right now, consequences will be that when the truth slips out, it is the PR disaster, legal action, fines, and trust deficit. So you have to be aware. The trust is very important. Once you lose the trust, then definitely it will not be repaired. It's not repairable. So from the business perspective, you have to be very keen observer regarding this, that you don't have to lose your trust. If you lose your trust, your reputation in the market, then definitely it will take long time to rebuild. And maybe the long time, by long time, there's no definition of long time. Long time maybe 10 years, 20 years, or maybe lifetime. Right now, the ethical perspective for this is this: transparency is not negotiable. It's non-negotiable things. And hiding or twisting facts violate the duty to inform. So, for example, a pharma company skips mentioning a failed drug trial. Okay, now stock soars, then crash when the FDA step in. So this is the misrepresentation of mission. Now let's move on. We have to discuss the final topic, that is insider dealing. Insider dealing and abuse of trust, and this is very important. What we mean by insider dealing? So insider dealing is classical. You say like a classic financial crime. I'll say here this is classic financial crime. Okay, so using the confidential information, for example, let's like a merger or earning drop to trade stock before the public knows, then this means that you are involved in insider dealing, right? So using the confidential information, let me write here. I think it will be written here, but let me write here. Using confidential information, then that for your own benefit, then you are doing the insider dealing. And the motive is this is pure greed. The motive behind this is pure greed, right? So insider cash in while other collect in the dark, right? So the consequences will be jail time, massive fines, and ruin your your career and market head unfair play. So ethical perspective here will be this this is the a textbook violation of fairness and trust, and everyone deserves an equal shot in the market. So this is all about insider dealing. Now let's talk about abuse of trust. Abuse of trust is this one. When someone is in a position, and if someone is in a position, okay, a position of power, like someone he is a CEO, CEO, or you may say like a CFO, Chief Financial Officer, misuses their authority for personal gain, like embezzling fund. So the more behind is safe and trust, it is less about the company and more about their own wallet. So the consequences will be criminal charges, company collapse, and betray stakeholders. And from ethical perspective, which is really important, you have to understand that duty and liability go out of the window. So the ethical perspective, this means that your duty and liability go out the window. It is a breach of the fiduciary responsibility owed to the company and its people. So, for example, a CFO steps into 2 million into a secret account. The company goes bankrupt and he caught red-handed. So that is he is using the using his power, and that is the reason that this is called the abuse of trust, right? Now, we have discussed this in a very detail. Hope you have understand. Inshallah, we'll continue in the next lecture. Here is the thing you have to learn. Summary of the financial fraud and effects. Financial statement fraud, mislead investor, inflated stock pricing lead to legal penalties. Who committed? Usually senior management due to access and personal gain. Common tactics, they are just overstating revenue or asset, understating expense or liability, hiding loss. Insider dealing, exploiting confidential information for personal financial gain, and ethical and legal consequences, heavy fines, lawsuit, loss of law, loss of investor trust, and reputational damage. So these are the things that you have to understand. We have discussed this in a very simple and a very clear way. Thank you for watching.